This is John. He's in his 20s and he dreams of getting rich. He has saved around $5,000 from small jobs he did and now wants to invest that money in the stock market. It's the year 2008 and he chooses BlackBerry to invest in. After all, BlackBerry is the leading smartphone producer in the world at the time. Nothing could have gone wrong, but within a year, John loses more than 75% of his money, all because he relied on the idea that past performance guarantees future success. I call people like John nostalgia investors, those who believe a company's past glory will continue into the future, but the reality is, the stock market doesn't work that way. Take the work of Michael Jensen as an example. He analyzed mutual funds and ranked the funds based on their annual return, called the first 50% winners and the rest losers. He found that just because a fund did well in one period, it wouldn't mean it would do well in the next period. In many cases, the opposite happened. Funds that underperformed one year, past losers, sometimes became winners in the next period. There was no consistent pattern. This also ties into Eugene Fama's random walk theory, which explains that stock prices fluctuate randomly around their intrinsic value, the true worth of a company based on its future prospects. Even when new information enters the market, prices often overreact or underreact before settling back around this new intrinsic value. This unpredictability makes it impossible to rely on past performance as a predictor of future gains. So, like John, many people rely on this myth, thinking that a company's past performance guarantees future success. And time and again, this belief has led average investors to lose much of their money. This brings us to another common myth. This is Emily. She has been investing for years and her strategy has been to time the market, buying low and selling high. Sometimes it works, but often it doesn't, and she ends up buying at a higher price than she sold. I call investors like her timing perfectionists. Timing the market is incredibly difficult. A study found that average investors earned less than half of the market's return, primarily because of poor timing decisions. And even more strikingly, a study by JP Morgan found that if you had invested $10,000 in the S&P 500 in 2003, by 2022 it would have grown to almost $65,000, averaging a 9.8% annual return. But if you had missed the best 10 days, your investment would drop to less than $30,000, and missing the best 20 would leave you with only $17,000 at a 2.9% annual return, all the way down to losing the best 60 days, which brings down your return to minus 4.6%. Also, 7 out of those best 10 days occurred within 2 weeks of the worst 10 days. Meaning even if you identify a bad day and sell, it's unlikely you'll re-enter soon enough to catch the best days that follow. So timing the market is extremely difficult, even for seasoned investors. The key to long-term success is staying invested, especially during periods of market turbulence. Another effective strategy is to invest regularly, a practice known as dollar cost averaging. This approach means you buy less when prices are high and more when they are low, naturally balancing out the highs and lows of the market. And this leads us to the next myth. It's the late 1990s and everyone is buzzing about the internet boom. Mark is caught up in the dot-com craze, investing heavily in internet companies. And like many, is convinced that because everyone else is buying, it must be a smart move. But by 2000, the bubble bursts and Mark's investments are wiped out. Mark was caught up in the popular believer myth. Herding happens because people often feel uncertain and believe that the crowd has better information. As Keynes pointed out, it's easier to follow the crowd to protect one's reputations. There's safety in numbers. But following the crowd in the stock market can be very costly. In bullish markets, investors are driven by greed, buying overhyped stocks, while in bearish markets, fear and panic take over. Schiller notes that market bubbles like the dot-com bubble and housing bubbles are products of this herding behavior. An alternative strategy is contrarian investing, championed by Warren Buffett and supported by Vanguard Research, which shows that fund managers who go against the crowd tend to outperform those who follow it. The key takeaway isn't to automatically follow or reject the crowd, but to base decisions on sound, independent research. For this next myth, let's look at Mike, who is 18 and a Gen Z. Mike wasn't interested in building a long-term plan. He wanted fast money. He bought into hot stocks that promised high returns, and by this point, Mike was sure that investing was just like gambling. He'd win big one day, but he'd lose it all in the next. I call these investors the gambler. Pretty obvious, right? The truth is, investing can be like gambling. Day trading or speculative investments can create huge swings. In fact, a study by CFA Institute found that 69% of Gen Z gamble and are more likely to invest in risky assets like crypto or NFTs, treating the market more like a casino. However, investing doesn't have to be like gambling. Over a 10-year period, the chances of achieving a positive return in a well-diversified portfolio exceeds 94%, compared to gambling's fixed odds of 100% loss in the long run. When you diversify your portfolio and take a long-term approach, the odds shift dramatically in your favor. Let's talk about Margaret, an investor planning for retirement and wanting to play it safe. She buys a 30-year US Treasury bond. 30 years go by and she realizes not only she has barely earned anything, but inflation has eroded her purchasing power. So, to eliminate all risks in an investment, you have to give up all the upside too. For example, let's say you buy a 30-year US bond with a 2.8% coupon rate. If you hold that bond to maturity, there's no way to lose your money, right? Wrong. The long-term inflation rate averages around 3%. So even with that plan, you wouldn't preserve your capital in real terms. However, as we mentioned in the previous myth, a well-diversified portfolio of stocks in the long run is almost certain to grow, and by a large margin compared to bonds. So if you focus purely on preserving your capital, in the short terms you may avoid market volatility but risk losing the real value of your investment. On the other hand, by pursuing growth with a well-diversified portfolio, you might see some short-term dips, but over the long run, you likely not only preserve your capital, but grow it substantially. The paradox here is that in order to actually preserve your capital, you have to risk losing it first. Beautiful, isn't it? So, after learning about these 5 traps that make average investors lose money in the market, you could say the market is like a game, where you choose whether to play or be played. In modern economies, tools like ETFs and index funds allow you to stay in the game with minimal risk, but seeking above average returns requires above average knowledge and expertise.